February 2026 told an eventful story through candlesticks. Every twist and every turn in the Bitcoin market this month was signaled in advance if you knew what to look for. Today, we go back to the beginning of February and walk you through every significant candlestick pattern bar by bar. Because when you learn to read what the candles are saying, the chart stops being noise and starts being a story unfolding. Today, we do a complete review of February 2026, 27 of the 28 bars. The current bar, as of today, on the 28th, is yet to close. This is Bitcoin technical analysis built on naked, pure price action. No indicators, no hype. The candles have lit up this chart with clues at every turn, and we are going to reveal all of them in this video. Welcome back. We are price action traders. Every day, we only focus on just one market, crypto, and just one crypto, Bitcoin. That's it. That singular focus is what makes us the Bitcoin technical analysis experts. Every day, we give you the answers to 5 fundamental structural questions. Where are the key price zones? Are the time frames in harmony? What is volatility telling us? What are the macro markets signaling? And what must change to revise current Bitcoin structure? Today, these questions will be answered through a single lens, the candlestick. Before we walk you through each of the February bars, let's overlay the context. The higher time frame context, the yearly trend, remains up. The monthly trend is down, the weekly trend is down, the daily is undecided. Higher time frame bullish structure being tested by lower time frame bearish pressure. That is the battlefield. Now, let's look at the battles fought through the month of February through candlestick analysis. The story starts on day 1. Saturday, 1st February, with a bearish inside day. But what is worth noting immediately is that the 1st, 2nd, and 3rd February could not reach the psychological round number of $80,000. All 3 bars butted their heads just under that level, $79,344, $79,284, and $79,136 respectively. 3 attempts, 3 rejections at the same ceiling. In candlestick analysis, this pattern is known as 3 peaks, and alongside those rejected highs, each subsequent low was breaking into new lows with long lower tails forming as sellers probed beneath. Sellers were giving us clues from the very first 3 days of the month. On the 4th February, the bears showed their hand. Price broke the 3rd February low and pushed decisively lower, closing at $73,038. The 3 peaks had done its job. The rejection at $80,000 was confirmed, and sellers were now in control of the short-term picture. The 5th February was the day sellers took the market down with a vengeance, an unmistakable bearish Marubozu, shaven head, opening at $73,007 and closing at $62,735 with virtually no upper wick. The bears had their foot on the accelerator. A range of over $10,900 in a single session. When you see a bearish Marubozu of this magnitude, the expectation is continuation, and that is exactly what followed. But here is where something significant happened. After 5th February drove the price down, and the 6th February followed through, creating a new low of $60,000, that's when things flipped. The round psychological number triggered a flurry of buy orders. Look closely at the bodies of the 5th and 6th February and you will see equal bottoms. The 5th closed at its lows at $62,734 and 6th February opened at both $62,855. This is a Tweezer Bottom, one of the most reliable reversal signals in candlestick analysis. The buyers who stepped in on the 6th reversed 96% of the 5th February's bearish range in just one day. That recovery established $60,000 as a powerful support level. As we sit here on the 28th of February, the 6th February bar is still containing all subsequent price action. Every bar since has closed within its boundaries. The 7th February produced a spinning top, a small body with wicks in both directions, representing pure indecision. Entirely unsurprising after the extraordinary ping-pong action of the 5th and 6th, the market needed to digest what had just happened. The 8th February then saw buyers attempt to break free of the 6th February range, pushing the high to $72,243, just above the 6th February high of $71,708. But the sellers were waiting to mug buyers. price was firmly pushed back inside the dominant bar's range and closed at $70,302, a failed breakout attempt. Let's pause here and notice something important. We started February unable to reach $80,000. We just saw what happened when price touched $60,000. But here's what the next 23 bars have quietly confirmed. Not one bar since the 5th February has closed above $71,000, and the overwhelming majority could not close at or above $70,000. The 70,000 psychological round number is acting as the glass ceiling. In short, the market has been trapped between a tight range of just $10,000 between $60,000 and $70,000 for the majority of February. If you haven't watched it, we'll add a link here to yesterday's video, Calm Before Chaos, where we talk about the key price levels you need to know for Bitcoin and explain the structural significance of each boundary. The 9th through to the 11th of February produced an unmistakable candlestick pattern of bearish bars known as the Three Black Crows. 3 consecutive bearish closes, each opening within the prior body and closing lower. The 9th opened at $70,350 and declined. The 10th continued lower. The 11th pressed further. A clear and deliberate message from sellers that they were in control. The sequence ended on the 12th with a spinning top, as indecision questioning whether prices should go lower. The next day, 13th February, buyers responded on cue with a bullish bar closing at $68,881. But the day after, the 14th, immediately issued a candlestick warning, an inverted hammer. The longer upper wick with the body sitting in the lower third of the range told us buyers had tried to extend the move but lacked the momentum to hold higher prices. The 16th February printed a neutral doji candlestick, open and close virtually identical. The market was confused. The 17th, 18th, and 19th saw the bears reassert themselves, 3 sessions of lower closes pressing price back toward the lower end of the range. But the 19th produced a hammer, a small body with a long lower wick, a bullish signal indicating that sellers had tried to push lower and buyers had rejected that move. The hammer closed at $66,951, and it marked the low of that particular sequence. The market responded. The 20th and 21st saw buyers push higher, with the 21st reaching $68,758. But the 21st produced a gravestone doji, a long upper wick with open and close sitting at the low of the session. Buyers had driven the price up during the session, but sellers arrived and pushed it all the way back down. The reversal warning was clear. The gravestone doji delivered its warning to those paying attention. This was followed up by sellers asserting their control on the 22nd, 23rd, and 24th, pressing price progressively lower. The 24th then produced a hammer, closing at $64,139, with a long lower wick reaching down to $62,527. Context is everything here. A hammer appearing at the end of a downtrend is a bullish reversal signal, but the same candlestick pattern at the peak of an uptrend is called a hanging man, a bearish warning. In this instance, with price having declined from the 21st, the reading for this would be a hammer establishing a potential floor. Bulls responded emphatically on the 25th February with a bullish Marubozu, also known as a shaven candle because of its barely visible lower wick. Opening at $64,097, buyers controlled all 3 sessions, Tokyo, London, and New York. Price surged to a high of $70,028, kissing the $70,000 psychological level for the first time since early February. But notice what happened. Sellers were waiting at exactly that level to push it back down. The candle closed at $68,773, below $70,000. The psychological round number of $70,000 was asserting its current influence in this range. We come to the last 2 printed bars on 26th and 27th, which were 2 inside bars, both sessions contained entirely within the range of the 25th February Marubozu. This makes the 25th, 26th, and 27th a harami pattern, the dominant bar containing the subsequent sessions within its shadow. The 26th closed at $67,515, and the 27th closed lower at $65,929. As we record on 28th February, the final day of the month, the Harami pattern has been violated as the low of $64,505 has been broken. The 28th candlestick is also the monthly close, and it will be interesting to see how it closes the month of February 2026. Step back and look at what the candles have collectively told us across 27 bars in the month of February. 3 peaks rejecting $80,000 at the open of the month, a bearish Marubozu driving price to $60,000, a Tweezer Bottom establishing the floor, 3 black crows confirming the bearish bias, hammers and gravestone dojis marking the turning points, a bullish Marubozu reaching $70,000 and being rejected, a Harami signaling exhaustion of that rally and now confirmed as broken. Each candle told us the next chapter in the story. Every candle was a clue. Every clue was giving us clues on how to be on the right side of the market to make money.
The conclusion the candles have collectively delivered is unambiguous. For the majority of February, the 6th February dominant bar contains it all. Bitcoin has been operating inside a $10,000 narrow corridor between the price levels of $60,000 and $70,000. Currently, $60,000 holds the floor. $70,000 holds as the ceiling. Not one bar since the 5th February has closed above $71,000. Identifying candlestick patterns alone can give you an edge, but when you read those patterns through a higher time frame structural lens, that's when you understand the structure and context as each candle was forming. That edge is significantly powerful. That is why we always believe structure defines context, and context defines edge. The volatility picture reinforces the candlestick narrative precisely. Daily ranges compressed from over $10,900 on the 5th February down to $1,091 on the 22nd, a 17-session compression following the dominant bar. Then, the 25th February Marubozu broke that compression with a range of $6,022. The candles and the ranges were telling the same story all along. Everything discussed today reduces to one closing condition. The 6th February dominant bar governs everything. Bitcoin can't break higher than $71,000, and Bitcoin can't break lower than $60,000. This defines the structural boundaries. Acceptance above the $71,000 to the upward path of $80,000 is of structural significance. A break below $60,000 is the structural line in the sand below. The candles will continue to light up the chart. We will be here every day to help you read them. Today is the last day of February, and the Harami low has been broken. The monthly close will print today and will be the final candlestick in this month's story. Sunday, 1st March, is a new month, and this week's close. Both closes that matter heading into March. We're here publishing only Bitcoin technical analysis built on structure, not speculation, every day at 7 a.m. EST. If today's briefing added value to your analysis, please consider subscribing. It helps everyone. We'd love to hear your take. Please comment below. Which candlestick pattern from February stood out most to you? We read and reply to every comment. Structure defines context. Context defines edge. Look after yourself.